Welcome to Croat's YouTube channel. My name is Asher Azim, and today we'll take a look at a basic structure of a 1031 exchange. Section 1031 has been part of U.S. tax code since 1921, and business owners have used this great strategy to increase cash flow by deferring taxes on the sale of their old equipment and reinvesting into replacement equipment. Let's take a look at an example. Assuming I'm a business owner looking to sell some old assets and planning to purchase some replacement asset or assets. So a few years back, I bought these two assets. Let's just say a dozer and an excavator. And each one, the original cost, or in accounting terms, the original basis, was $200,000 each. Now, as a business owner, I have this great benefit to depreciate these assets right off the cost every year on my tax returns. So let's say I've depreciated these two assets fully over the years. These are the original bases. $400,000 for two assets. This is depreciation taken over the years. Now, at the point of sale, when I'm looking to sell, I have to take a look at what leftover basis is, or the adjusted basis. So the original basis minus depreciation, I'm left with zero basis, or adjusted basis in the two assets. So in either case, I'm taking these assets to an auction or a private party, and let's just say I sell it for $200,000 today. I'm looking at recapture of the depreciation that I've taken over the years, and that can be taxed anywhere from 30 to 40% depending on state and income taxes, state and federal taxes combined. So this $200,000 in sale price is subject to 40% in tax exposure. Now, after paying taxes, I'm left with $120,000 over here to reinvest into my business. Now, let's just say the asset I'm looking to purchase for my business, whether it be an excavator, scraper, or grader, that's going to cost me $200,000. Now, as you can see, I have $120,000 to replace this $200,000 asset. So either I have to bring it from my pocket, the difference, finance it, or I'm short $80,000 over here to take ownership to that replacement asset. Now, on the other hand, if I convert the sale and purchase into a tax-deferred exchange, the first thing I need to do is call a qualified intermediary to make sure the transaction qualifies as a like-kind exchange. There is some paperwork involved, and also we need to make sure the transaction is within the safe harbor guidelines. So the qualified intermediary, or more commonly known as QI, will handle all that for me. One of the key requirements is that as an exchanger, I cannot have any actual or constructive receipt to the funds from the sale. And once all that is done, this 40% tax exposure can be deferred with a 1031 exchange, and now I can reinvest the $200,000 to buy this replacement asset without bringing anything to the table or finance it, but use all the proceeds from the sale to reinvest into my business. Also, I need to make sure that the transaction, the 1031 exchange, is time sensitive. There are two key deadlines that I need to be aware of. Everything triggers from the point of sale, legal ownership transfer on the sale, and completes at the acquisition of replacement assets. Initially, I have 45 days to identify my replacement assets, asset or assets, 45 days to ID, and I have a total of, running simultaneously from the sale date, total of 180 days to take ownership, legal ownership to the replacement assets. So this is a very basic structure. Today we looked at what are the key requirements, deadlines involved. We'll discuss much more in detail what are the key requirements. Also, we'll take a look at safe harbor guidelines. Thank you for watching today. If you would like to learn more about 1031 exchanges, please visit our website at acquirement.com or subscribe to our YouTube channel. Thank you.